Hello and welcome to this property webinar brought to you by Moneyweb. My name is Suren Naidoo and I've been covering the property sector for over 15 years. In this webinar, we will be chatting to leaders in the listed property sector about the performance of listed property or real estate investment trusts as they are known in the context of 2020 having COVID-19 hit, and it's been quite a tumultuous year, especially for the listed property sector. Joining me today are three well-known faces in the listed property sector. First off, we have Estienne de Klerk, CEO of Growthpoint Properties, South Africa. Estienne is a familiar face in the industry, having had several roles in industry organizations, and is currently the chairperson of the SA Reit Association. Then we have the rose amongst the thorns, as it were, Pranita Daya. Pranita is a listed property analyst from Anchor Stockbrokers. Anchor does quite a bit of research in the sector, and Pranita is often covered or commentates on the sector's performance in the media and in other spheres. Lastly, but not least, we have Keillen Ndlovu. Keillen is from Stanlib. He heads up listed property fund at Stanlib. Like Estienne, he's been around for a long time in the industry. He's at Stanlib for 10 years, but he started off in Standard Bank, and probably around 20 years, I would say, Keillen. Welcome, everyone. Looking forward to a lively power-packed discussion.
Hi, everybody.
Thank you.
Thanks, Suren.
I hope the connections are fine. We'll have to go into webinar mode. There hasn't been a SAPOA or RIT convention in a few years, and hopefully it changes next year. But we've got quite a great response to this webinar, and we're looking forward to getting some valuable insight from the three of you. Just to let those that have registered know that this webinar is being recorded, and there will be recordings available later today as well as on Moneyweb website. Just to kick things off, I want a little bit of insight from your side, Pranita. Just in terms of how badly the sector did from a total return perspective in 2020, COVID crazy 2020.
Sure, Suren. I think, perhaps I'll answer that question in two parts. So firstly, as a direct answer to your question, the total return for the SAPI was around -35%, and for the OP, which is basically the all property index that includes a few more of your pure offshore counters as well, it was around -36%. And the split between that total return is, of course, your capital return as well as your income return. And just to give a bit of light on that income return point, we obviously did a bit of work looking, for calendar year 2020, what did the distributable earnings growth look like amongst these SAPI counters? And we got to a number of around -23%, which, I mean, you can understand that that's quite a weak number, and thereafter, still applying payout ratios. There were very few counters that actually need to pay 100% of earnings out. For the most part, a lot of the counters reduced their payout ratio to 75% or just above. And of course, we had redefined on the basis of the solvency liquidity not paying out a dividend at all. So you can understand how impacted that number was, particularly just from an income return point of view. And I think secondly, then it's important to look at it as well from a constituent point of view. So I think to give a bit more perspective into what really drove the weaker performance relative to those that were stronger. And I think we found a few patterns among his constituents. We've seen a few of those with the more stretched balance sheets, elevated LTV ratios, coming in at the bottom of that pack. Really, your TAC redefine, Vukile that we saw towards the bottom of and really, the two weakest performers were your UK retail pure offshore counters as Hamilton and Capital and Regional, which obviously has a feed-through impact through to Resilient and Growthpoint. And then, on the flip side of that, of course, your pure offshore plays with no retail exposure being the likes of Sirius and Stenpark were those that had, some positive growth, as well as your local counters like Equitas, Foodvest and Storage were really more resilient subsectors that saw a bit of, better relative growth. So I think that, just to give a bit of insight into that number as a whole.
Thanks for that. I just want to also maybe stick with you a little bit longer, Pranita, and maybe Keillen would want to weigh in here in terms of 2020 compared to 2019 and 2018. Now, 2018 was a terrible year, annus horribilis of sorts. That was largely driven by the debacle in the resilient stable. That has been it's water under the bridge and wrongdoings. FSCA found no wrongdoings. But 2018 was a terrible year. 2019 there was a slight recovery, but from an asset class perspective, ritz were still one of the worst performer. And then 2020, people thought, okay, it'll be a better year, and then COVID-19 comes in. Maybe give us a comparison between the 3 years, 2018, 2019, and 2020. I'm just trying to understand how badly the sector has declined, perhaps over the last 3 to 5 years. Firstly, Pranita, and then Keillen.
Sure. So, to kick off from my side, I think, 2018, of course, the whole resilient stable debacle happened, right at the beginning of 2018, and that really set the tone for the rest of the year. We saw, negative 25% odd total returns coming from the sector at that point. And it really was, coming from a year where we had gotten used to seeing, quite significant premiums to NAV on a couple of counters. And as you would know, we haven't really seen that situation since. But I think that resilient stable debacle and everything that sort of ensued during that year really started to unfold, some of the underlying issues in the sector from perhaps a governance point of view, from, transparency, disclosure, comparability, etc. And really, when you compare that negative 25% to the 35% we saw in 2020, you really understand the enormity of, the impact of that whole debacle in 2018. 2019 wasn't really much better, but at least we had sort of marginal positive growth. I think it came in at around 2%. So really, coming off a very low base in 2020, we really expected to see some kind of recovery, which COVID-19 and the pandemic really turned on its head. So,
yeah. From your side, I know you talk about property being a medium to long-term investment. Where are we standing at the moment?
Yeah, just to add on to what Pranita said, if you look at the sector in the last 3 years, it came from premiums to NAVs of between 10 to 20%. And then looking at last year in the West period, around April, May, the discount NAV was as much as 55%, if not 60%. And that's come down to the 30% level. So we've seen a nice recovery in the sector, mostly in Q4 last year, as well as Q1. So what's important to highlight is that the last 3 years, apart from 2018, which were other issues, the economy was weak. So COVID-19 came at a time when the property sector was facing a couple of challenges, particularly the office sector, as well as the retail sector to a certain extent. But the sector is quite well diversified in the local markets and offshore markets. And that's why you find that it's been able to actually manage to survive in this tough times. We haven't had any casualties in terms of listed property companies, despite balance sheet weakness.
Estienne, it's your time now. Estienne, like Keillen, you look young, but you've been in the game for a few decades now. I'm sure you've seen the cycles, and we always think in South Africa, things get worse. And then COVID-19 hit. from your side, do you think it's like 2020 was the worst year and we can only get better from here? What's your general thoughts on where the industry or REIT sector sits at the moment?
No, thanks, Suren. You can see which guys have to run the property companies and which ones just invest in them. I look much older than Keillen, and we've been in the game about the same time. So the reality is that there were times last year which I think many real estate executives were thinking they were going to face a near-death experience there. If you switch off any company's cash flow for a couple of months, the liquidity is under pressure. And you have to contextualize last year's sort of performance with the South African economy retracting by 7%, but more specifically, the bulk of the economic activity is in the Gauteng area, and Gauteng went back 17%. Now, that number rolls off the tongue very easily, but if you put it into actual economic activity, it is absolutely unbelievable the damage that was done last year in the client bases of the real estate sector. And ultimately, we are a little bit of a window on the economy, and we are a bit of a lagging sector. So if you look at the eye of the storm, clearly, things are much better than they have been in let's say, the period between April, May and June. I mean, just to contextualize, in that period, Growthpoint provided between, let's say, for the 6 months to December, over 550 million rands worth of relief to tenants in the form of discounts and deferrals. Now, those numbers are absolutely humongous, and at the same time, as leases are coming up, we're facing, a lot of pressure on rental levels across the board. So none of the three sectors are really main sort of commercial sectors, retail, office, and industrial, are really spared. And as such, it's a difficult time. I think what you will find is, from a cash flow perspective, things are improving. So, your arrears levels, etc., are starting to come down across the sector, and hopefully, if there aren't any further lockdowns, that will continue to improve. And hopefully, we will recover some of the lost ground in the economy, because what we have seen across the board, whether it's retail, office, and industrial, there's actually oversupply in all three sectors, just given the economic activity out there. So the South African economy shrunk, demand shrunk, and all the other little sideshows, whether it's online retail or work from home, I don't think are, specks on the wall compared to this impact of the economy. And I think there are sectors that have been able to kind of do well, so mining and agriculture, and to some extent maybe information technology have done it right, but the real estate sector is very much diversified across various sectors of the economy, and unfortunately the sectors that we have dominant exposure to, they have been punished quite a lot.
Thank you, Estienne. Going back to my question with you, Pranita, I know it's property industry needs to be forward-looking, but I just wanted to get an understanding of the lost market cap last year, as opposed, from a total return perspective, the sector was down around 34-35%. But part of that is related to dividends and that sort of thing. But how much did the market actually lose from a market cap perspective for REITs?
Sure. So I mean, I've gone into a bit of around the income return side of it. So certainly from a capital return point of view, I mean, bearing in mind that, of course, it is really influenced by the different share price movements, in that weighted number, as well as the various, changing ratings of each counter. If we simply looked at the market cap at the beginning of 2020 versus the market cap at the end, we get a number of around minus 37%, in terms of the market cap that was lost. So really going, all property index point of view, going from around 520 billion at the beginning of the year down to around 330 billion, and that still taking into account the 2 months of better sort of growth in November and December that we saw. So really significant decline experience from a capital return.
Some of our registered participants are asking some of my questions, so they are coming, everyone. Before we go, let's go to Keillen. Keillen, maybe I'll put you on the spot here. I know the sector is up like 1% so far this year, but other heydays of REITs over 2013, REITs legislation came into South Africa. 2014 to 17, we saw a flurry of listings, and it was almost a kind of a boom despite challenges in the South African economy structurally and all the things that the property counters complain about, whether it's rates and all these other things. Are the heydays of REITs over, or is there light at the end of the tunnel?
Well, like, as I mentioned probably earlier as well, is that if you look at, so the key thing to watch out for in this market is balance sheet strength. So what you've seen in most REITs, they've cut their payout ratios to support the balance sheets, moving from 100% payout ratios to the minimum required of 75%. And they'll use the balance to pay off debt. So that's helped to support the balance sheets. The LTVs are higher than what the market would like, at about 42% on average. We'd like to see that number come down to about 40%. So that's from an LTV perspective. But if you look at the covenants of the banks, they sit anywhere between 50 to 60%. So none of the major property companies, or basically most of them, they are not in breach of those covenants. So property companies are doing well from that perspective. Yes, earnings declined over the last year, and we still expect a decline of about 5% or so this year, and then looking at a recovery of a low base next year of double digits, and then normalizing at about the 5% levels in line with inflation. So last year was actually a reset year, but then going forward, the companies are doing the best they can to make sure they are quite stronger.
Since you're one of the biggest asset or investment trust managers in South Africa, Stanlib, the investors that you deal with, whether it's institutional investors or retail investors, what are you finding? Are they more cautious? Is it a case of them shunning the listed property sector? Or I just want to understand in terms of inflows and outflows, where things are standing from a fund management perspective at the moment.
Yeah, so it's quite interesting. Last year, we were worried that you might see a huge run on the sector, and we didn't see much outflows last year. There was not probably a single day we were forced sellers or the funds were left. So, of course, there was a big fall in the markets in April, May, and then there was a wait and see from clients. And then the second, third quarter challenging, but as the fourth quarter came through, there was value coming through in the sector with discounts NAV of 55% thereabout. And you saw a huge increase in terms of inflows, mostly from institutional clients. We saw big value in the sector, as well as retail clients. So retail clients didn't pull out as much as we'd expect. And then in the first quarter as well, we're seeing inflow still coming through, and we're seeing multi-asset funds, balance funds increasing their property exposure, mostly from Q4 last year.
Thank you, Keillen. In turn, Estienne, perhaps all the panelists, but maybe Estienne, you want to talk here. It seems maybe from a REIT perspective, historically, SA REITs has paid out 100% of dividends or distributions, and there wasn't really talk of lower distributions before last year or before COVID-19. Now we're seeing deferred dividends. As COVID-19 forced a reset of the sector, would you say a lot of counters are looking at a minimum of 75%, and some counters have been forced not to pay? But that may be a question for Keillen.
Yeah, so I think that SA Reit, the association, actually, prior to COVID, had already engaged many of the institutions. We had conducted 1 or 2 road shows as SA Reit with some of the executives involved in the listed property companies. And, the topic of reduced payout ratios had already been raised in those discussions. So it's not a new topic. I think the complexity is that, to the extent that you don't pay out money, you're obviously paying tax on it. And that sort of defeats the purpose a little bit of this principle of having a flow through tax efficient vehicle. And at the same time, there were certain sensitivities from the sector as to what impact that would have on maybe a change in regulation, etc. So what we have been doing is we have before and after COVID, we have been engaging the regulators, discussing items like distribution payout ratio, the taxation thereof, the provision. I mean, the main issue was really that, to the extent that that REITs are paying out all their income, they have to borrow money to maintain their properties, the maintenance capex component at a minimum, and I think that certainly poses a bit of a question as to in an environment like that, clearly sustainability and liquidity is going to become a challenge, and LTVs will be under pressure. So we are talking to the regulators. It's quite difficult to get airtime with these guys because they're busy people, but there's a whole bunch of other topics on the table. So, valuations, just the external valuations and the frequency of these, the gearing levels for the sector, and disclosure. So I think the real estate sector, albeit sort of criticized because it kind of gets a homogeneous sticker put all over it. But, as a sector, I think we're the only sector that has a best practice recommendation on reporting, and in fact, we've already got a second version of that, which we've been driving quite hard, which, for the analysts must make life much easier. And I think also the investor community has been particularly spoilt. I can remember days when certain analysts got incredibly upset with us because we weren't prepared to disclose what we believed the distribution was, or we did disclose it and we were out by 0.2 of a cent or something. So I think reality has set in, and I think that will be something. I mean, no other sector really predicts their income to 0.2 of a cent, or even to a cent, for that matter. And in this kind of environment, I think those days are way gone. So, but I do think we've always strived to improve disclosure for the sector, and I think that has helped the understanding of the sector. And then I think there will be a bit of discussion around kind of asset classes that we can accommodate in REITs. There are certainly other infrastructure and other sectors that I think probably can be included, which will, bring more liquidity into the sector. But I think overall, if you think about the sector, there's no doubt that it's been massively impacted, and as such, you've seen, market caps probably recover to just under half of what they used to be. So it's been painful. I can tell you that for all of us and our investors, and hopefully what we'll start seeing is a slow build up again, to where things were. But it's going to take a little bit of time. And as correctly pointed out, I think the market still has to digest a reduced payout ratio, which I think most of the companies are using now, and I do think it's a reset of the base to a large extent.
Mm-hmm.
You've answered my next question, because it kind of follows on in terms of, is the core question of this webinar, is the sector resetting? So then maybe you want to follow up, Keillen, from your perspective. I'm sure you share some of Estienne views, but are the 100% payout ratios over? One of our registered panelists have asked about how sustainable is it going forward. Obviously, now it's no longer the case, the 100% payouts?
Yeah, so it depends on your LTV. So the higher the LTV, the more challenging it becomes to pay out all your earnings, because you can't, there's challenges with raising equity in this market, or even selling assets to pay off debt as well. So retaining income is one of the easiest routes. And you also mentioned that some of the REITs opted not to pay out any distributions. Redefine was one of them. They're citing potential liquidity challenges. So the key thing to consider is that REITs are required to pay out at least 75% of the earnings to investors, but provided that they will pass the solvency liquidity test after paying out the distributions. So that's a cautious move by some of the REITs as well. So we'll expect lower payouts. And then what we're seeing now is well that most REITs will opt to skip the interim dividends and then use the cash in between during the financial year and then pay out the 75% minimum at the end or at the financial year end.
Yeah, maybe, Suren, just one on that. I mean, I think that many REITs have, you know, been forced in a way to go to the dark side, if you'd like. And I mean, if you claiming solvency and liquidity failure, you know, going concern and all these nasty accounting concepts come to the fore, and that's not really where we want the sector, right? So we are busy. We've got a committee that focuses on research at SA Reit, and we're working together with the regulators to do a bit of research around the globe to see what level of flexibility you know, the regulations globally provide those in those jurisdictions, and hopefully we'll be able to bring a little bit more flexibility than the sort of 25% odd back in the future, and at least, you know, maybe have appropriate tax treatment, you know, if you do retain for, let's say, maintenance capex or whatever the case may be, that you know that there's a appropriate taxation for that. But I think it's not ideal for us as a sector, that would be my view, to find a situation where companies are, you know, using the back door to try and retain distributions. You know, we believe that these things should be more transparent, and that the regulations should be flexible enough. And I can tell you, you know, when we negotiated the REIT dispensation with National Treasury in 2011 and 12, the distribution payout ratio item was, you know, something that came in reasonably late in the discussion and ultimately became a requirement. So it was, you either do it or you don't get REIT dispensation. So it was sort of the give and take in the negotiations at the time, given that that was one of the reasons why we could get REIT dispensation. But at that point, we did highlight immediately the risks that that distribution payout ratio, you know, presents, and we did build in a bit of flexibility to the extent of 25%. But I think nobody in their right mind in 2012 and 13 would ever have expected what we've seen in 2020.
Mm-hmm.
Question. Time is flying. Pranita, I just wanted to ask from your perspective, what is the worst aspect? What is the most frustrating, well, not frustrating, but which area is the most troubling for you as Anchor Stockbrokers? Is it you know, the devaluation side? Obviously, a lot of it is out of the property industry's control with the economy and South Africa's structural issues and that sort of thing. But is it devaluations? Is it the spiraling LTV levels and debt? The stock market uncertainty you can't really control, but is it devaluations, LTVs? Which area is most concerning for you?
Sure. So, I mean, to be honest, Suren, I think it's quite a combination of all of those factors that you've mentioned, really. I think, you know, what's sort of, you know, key to mention is that going into 2020, you know, a lot of these issues were not really caused by the pandemic. They were really just, you know, amplified by it, or, you know, accelerated to some extent. So I think to put it into context a little bit, you know, as we saw it, it's you know, pre-2020, there really was a really short-term focus in terms of dividend growth. And I think that really stemmed from really trying to really feed investor appetite for the growing dividends, and that came at the cost of doing these yield accretive deals, sometimes at the expense of long-term value creation and long-term earnings sustainability. And I think just having mounting sort of debt to fund these transactions at the time when your valuations were fairly stable or to some extent on the rise, it didn't matter as much. But going into 2020, we saw obviously devaluations coming down as a result of really weak property fundamentals, and that obviously having the default impact on LTV ratios. I think that's where throughout 2020 our main concern has really been stretched balance sheets amongst these REITs, and that sort of extends to a number of issues, from the elevated LTV ratios to concerns around liquidity, around debt capital markets, and whether finance would be able to be rolled over. I think a lot of those issues have to some extent dissipated, and I think REITs have really risen to the challenge in terms of alleviating these issues and remedying their balance sheets. But I think what's key in terms of that is just the downfall of it all has been really that if REITs went into 2020 perhaps in a stronger position, they have exploited opportunities to provide more liquidity to the market in terms of investments in unlisted entities, or really taking advantage of good pricing at that time, which they were unable to do because of the lack of headroom on the LTV ratios. So I think really the point has been really the opportunity cost in that regard, from our point of view. I think that I probably should mention, and I think is worth mentioning, is amidst all of the activity that surrounds the sector, certainly something we have to mention is, of course, the way the property group came together to provide that COVID rental relief, and the significant contribution that was made to the economy by the property sector in that regard, and particularly to SMMEs.
Well, we've reported on that quite a bit. Estienne's talking about Growthpoint. It's the largest REIT giving rental relief of over R500 million. In total, SA Reit Research, which you were involved in, Pranita, together with other researchers, comes to around R3 billion. But we chatted to Joanne Solomon, the CEO of SA Reit, last week or the week before, on Moneyweb's new property podcast, the Property Pod, which I host, and she said it could double, even though we don't have hard lockdown. She said there are still quite a bit of relief going in, maybe not as much as before, but it is. You talked about devaluations, Pranita. I'm going to turn that to Estienne now. I know last year, I think it was Growthpoint's pre-close presentation, or one of the presentations last year, where Estienne and Norbert was chatting to the media, and both of you talked about expectations around devaluations of between 10 and 20%. Obviously, it depends on specific counters, but you had other counters in the sector disagreeing or playing it down, probably. What's your thoughts around devaluations? Have we already faced the worst, or is there a little bit more pain to come from a evaluations perspective? Because that also comes to the heart of how the market perceives values, and you look at the huge discounts to NAVs at the moment, and property fundamentals ultimately.
Yes, I think, Suren, clearly we sort of took this is now what must be 18 months ago, feels like a million years ago, but we spoke about 10 to 20 odd %, and I think both Norbert and I were quite surprised as to how quickly some of that came in through the numbers, and given what happened in COVID. So we've seen those devaluations come through much quicker than we had anticipated, because we had said it would be maybe like over 2 years kind of thing. So that I think is certainly a factor. And I think the two, you asked Pranita what were the two biggest concerns, for her about the sector. For me, there's two things: the economy on the one hand, and then obviously liquidity on the other in the sector are two big factors, because they do have an impact on valuations. And you will see, naturally, I see a compression in those discounts as valuations come under a bit of pressure. Where are we? I think, look, we've taken quite a lot of medicine, some of us more than others. So you might find that the valuation fraternity, applies a little bit more of an even hand across some of the other valuations in the sector. But I do think, given what's happening in rental markets, that there will still be a bit of weakness in valuation still to come. And that probably will be for the next maybe 18 months, given what's going on here. You don't just wipe aside a 70% reduction in the economy in Gauteng and then think, that's not going to have any impact. And then, fundamentally, there hasn't been a lot of liquidity. Interestingly enough, we've been able to sell not huge volumes, but we've been quite prudently selling assets very, very close to our stated NAVs. And so there is a bit of liquidity, albeit a little bit patchy, and certainly more down the smaller end. So we're not seeing big institutional capital coming in and mopping up. We have got one or two investors that seem to have kind of international money that is looking for a home that's spinning about a bit. So, you might see some bigger deals going through. And I mean, there are a lot of assets that are for sale, and some companies you can pretty much buy any asset that you want to. So the big issue is going to be, how the liquidity works through with the financial institutions. The banks are pretty cautious in this environment, given what's happening in the valuation market. And then, as a buyer, it's quite difficult to know where value is actually at. If all the things are moving, so cap rates are all over the show, rental levels are all over the show. It makes it much more difficult to really understand, are you good or not?
Thank you, Estienne. We've just got a few minutes left. Keillen, we got a question from Boy Cabrello. Do you expect changes in REIT legislation that would see REITs having greater flexibility? And I know Estienne touched on that a bit, so Estienne might want to chip in here, but last year with COVID hitting, I know the SA Reit approached the Treasury about possibly even allowing REITs to relax legislation to maybe not pay out dividends for a year or two. But they weren't, I don't think they were very keen to that. But will we see a little bit more relaxed legislation now coming in?
Yeah, that's an interesting question. I think Estienne touched on that, and do it best to answer that because it's been involved in those discussions.
Estienne, over to you.
So I think, Suren, as we pointed out, we are working with the regulators to find a more functional landing on some of these things. I mean, to be honest, the sector got no relief at all from the regulators, other than which was generally provided by the JSE, where companies could, defer dividends somewhat, and then obviously report a bit later. But that didn't really help our sector. And as a sector, you pointed out, I don't think there is another sector that provided as much liquidity to the businesses that actually needed it when they needed it. And I mean, now there I'll contextualize, the banks together with government and National Treasury put in a funding plan for, I think, 200-300 million odd. And I think they deployed all of 18 billion, which is not going to make much of a difference. If you just consider the real estate sector and that report that was done, some of the companies were only literally in for 2 months, in terms of their reporting. So we're going to repeat that. And it will be evident of how much liquidity the real estate sector has actually pumped into the South African economy.
Fantastic. We've got 1 minute left. Apologies, Pranita, we'd have to end there, but I just want to get a last comment from Keillen's side regarding expectations. We talked about the sector being 12-13% up. Do you think this is going to could the REIT sector be the top performing asset this year, despite all the uncertainty?
We still believe there's more upside to the sector, obviously off a low base. Let's not forget last year the sector lost over 35%. And even from valuations, NAVs are still going to decline, but currently we are about 30% discount NAV. Over the medium to long term, we're looking at that coming down to the 10-20% levels, which implies more upside to the sector. And from an income growth perspective, negative this year, going double digit, 10-15% growth in distributions, and then normalizing at 6%. And the yield, you're looking at 8 to 9% on a distributable income, per share basis. That's 8 to 9%. Then if you add what's not paid out, you're looking at 11-12% yield, which is basically your distributable income per share. So there's still more upside to the sector when it comes to earnings. Obviously, there's challenges around COVID and the office market and the retail sector. It's off a low base. We're still looking at double-digit returns over the next 12 months.
So it might be a buy opportunity for SA Reit. I think that's the key message coming through. We're actually over time now. Thank you so much, Pranita, Estienne, and Keillen. We might need an hour next time. Just to let participants know that you can download the recording, which will be emailed to you, or you could pick it up from Moneyweb's website at moneyweb.co.za. You can also follow Moneyweb at Moneyweb on Twitter, LinkedIn, and Facebook. Thanks very much, and all the best.
Thank you. You're welcome.
Thank you.
Thanks, folks. Chat soon.